This is a demonstration of problem 15.3b, Equity Transactions and Statement Preparation. Meriwether Company has two classes of capital stock outstanding, 7% $50 par preferred and $1 par common. At December 31st, 2020, the following accounts were included in stockholders' equity, and the problem gives us the preferred, common, par values, the paid-in capital in excess of par for preferred and common, and the retained earnings balance. It also gives us transactions that affected stockholders' equity during 2021, and the problem states prepare the stockholders' equity section for Meriwether Company at December 31st, 2021. So what I have done is I have T accounts for each of the stockholders' equity accounts with the beginning balances listed for each one of them, and then we're going to go through and analyze each one of the transactions that occurred during 2021 to post those to the stockholders' equity account so that we'll have the correct ending balances to do the statement of stockholders' equity. So the first item is on March 23rd, a 4-for-1 stock split was issued or declared, and it reduced the par value to 25 cents a share. So when we have a stock split, we do not make a journal entry. We make a memo entry only, where we list or show the number of shares that are now outstanding and the par value. So notice that we originally had 5 million shares and it was $1 par. So now we have 4 times that number of shares and we have only a 25-cent par value, and that does come into play later in the problem. On April 1st, it says 25,000 shares of common treasury stock were purchased at $12 per share, and Meriwether uses the cost method. So 25,000 shares times $12 is 300,000, and that would be posted to treasury stock as a debit. The next item states that 50,000 shares of preferred stock were issued at $51 per share. So the par value of the preferred is $50. So we multiply 50,000 shares times $50 and we get $2,500,000 that would be credited to the preferred stock account. $1 per share, since the stock was issued at 51 times the 50,000 shares, or $50,000, would be posted to paid-in capital in excess of par of preferred stock. The next item states that on August the 18th, 15,000 shares of treasury stock were reissued at $13 per share. So the treasury stock had originally been purchased at $12 per share. So it's being resold for $1 per share more. So the credit to treasury stock would be for the original cost. So 15,000 times 12 is $180,000, and that would be posted as a credit to treasury stock. The $1 per share, that was for the additional $1 for $13 times the 15,000 shares, or $15,000, would be posted as a credit to paid-in capital from treasury stock. Next, the problem states that 120,000 shares of common stock were issued at $14 per share. So this is where you have to be careful, because remember now the par value of the common has been reduced to 25 cents. So to determine the credit to common stock, we take the number of shares, 120,000, times 25%, and the credit to the common stock would only be $30,000. The remaining $13.75 times the 120,000 shares, or $1,600,000, $650,000 would be credited to paid-in capital in excess of par common stock. The next item states that on December the 31st, the preferred dividend is declared and a common dividend of 15 cents per share is declared. So when we pay the preferred dividend, it will be paid on the par value of the shares. So first we have to determine what is the par value for the preferred. We can look up at our account and we can see that the par value is $12,500,000. So $12,500,000 times 7% is $875,000 for the preferred. In order to determine the common stock dividend, we need to know how many common shares are outstanding. So we had 20 million shares after the 4-for-1 split. We purchased 25,000 shares of treasury stock. So treasury stock does not receive dividends. However, we reissued 15,000 of the 25,000, so we would add those back, and then we issued another 120,000 shares. So the ending number of shares is 20,110,000. Then we would multiply those by 15 cents a share to get the common dividend of $3,016,500. We would add the preferred dividend of $875,000 to the common dividend to get the total dividend of $3,891,500. That would be debited to retained earnings. The last item is the problem tells us that net income for the year was $4,650,000. And that would be credited to retained earnings. So now we have all of the balances in the stockholders' equity section: $12,500 for the preferred par, $400,000 for the paid-in capital in excess of par for preferred, $5,030,000 for the common stock par, $70,350,000 for paid-in capital in excess of par common, a $120,000 balance in treasury stock, a $15,000 credit balance in paid-in capital from treasury stock, and retained earnings is $13,538,500. So now we're going to complete the stockholders' equity section for Merriweather Company as of December 31st, 2021. The preferred par value, as we stated above, was $12,500,000. The par value of the common stock at the end of the year was $5,030,000. So the total capital stock is $17,530,000. The excess over par for the preferred, as we saw at the top, was $400,000. The excess over par common from the top was $70,350,000. And the excess over cost for the treasury stock was $15,000. So total paid-in capital is $88,295,000. Retained earnings ending balance was $13,538,500, which we would add to the $88,295,000 that included the par value also of the common stock to get total paid-in capital and retained earnings of $101,833,500, and from that we would deduct the debit for the cost of the treasury shares, which was $120,000. So the ending total stockholders' equity at December 31st, 2021 was $101,713,500. And that is the conclusion of the demonstration for problem 15.3b.